National insurance. By the late 19th century, government began to initiate national insurance program against sickness and old age. Germany built on a tradition of welfare program in Prussia and Saxony that began as early as in the 1840s. In the 1880s, Chancellor Otto von Bismarck introduced old age pensions, accident insurance and medical care that formed the basic for Germany's welfare state. His passionless program won the support of German industry, became it goes where to win support of the working classes for the empire and reduce the outflow of immigrants to America, where wages were higher but welfare did not exist. Leaflet promoting the National Insurance Act 1911. In Britain, more extensive legislation was introduced by the Liberal government led by H.S. Asquith and David Lloyd George. In 1911, National Insurance Act gave the British working classes the first contributory system of insurance against illness and unemployment. All workers who earned under 106 a year had to pay 4 pennies a week to the Sims. The employer paid 3 pennies and general taxation paid 2 pennies. As a result, worker could take sick leave and be paid 10 shillings a week for the first 13 weeks and 5 shillings a week for the next 13 weeks. Worker also gained access to free treatment for tuberculosis and the sick were eligible for treatment by a panel doctor. The National Insurance Act also provided maternity benefits. Time-limited unemployment benefit was based on actuarial principles and it was planned that it would be funded by a fixed amount each for workers, employers and taxpayers. It was restricted to particular industries, cyclical industries like construction of ships, and neither made by provision for dependents. By 1913, 2.3 million were insured under the scheme for unemployment benefit and almost 15 million insured for the sickness benefit. This system was gently expanded after the Second World War under the influence of the Beveridge Report from the first modern welfare state. This system was greatly expanded after the Second World War under the influence of the Beveridge Report from the first modern welfare state. In the United States, until the passage of the Social Security Act in 1935, the federal government did not maintain any of insurance upon the nation as a whole. With the passage of the Act, the new program expanded the concept and acceptance of insurance as a means of achieving the individual financial security that might not otherwise be available. The expansion experienced its first boom market immediately after the Second World War in the original VA home loans programs that gently extended that the idea that affordable housing for beverage was a benefit of having served. The mortgages that were underwritten by the federal government during this time included an insurance clause as a means of protecting the bank and lending insuring invalid against avoidable losses during the 1940s. 3 was also the GI life insurance policy program that was designed to ease the burden of military losses on the civilian population and serviceors.